How fear keeps the global economy. Alive fear is often considered a purely personal emotion, something that affects individual decisions in subtle ways. But on a global scale, fear is much more than a private feeling. It is one of the most powerful forces driving the entire economy. Every stock market fluctuation, every policy shift, and even consumer behavior can be traced back, in part, to how fear influences decisions. Imagine the world as a massive machine where millions of people, institutions, and governments constantly react not only to facts, but to perceived threats, uncertainties, and anxieties. Fear becomes the invisible engine that keeps the wheels turning, sometimes faster than logic itself could manage. The strange reality is that without fear, many of the economic systems we take for granted might function very differently, or even collapse entirely. Markets thrive on volatility, spending relies on urgency, and investors constantly reassess risks based on what they think could go wrong. Fear drives movement, momentum, and attention in ways that pure optimism rarely does. Understanding this principle is critical because it explains why economies grow, shrink, and adapt, not just based on what people earn, save, or invest, but on how they feel about uncertainty and risk. The interplay of fear and the economy is intricate and constant. Governments adjust policies in response to public sentiment. Corporations tailor products to perceived anxieties. And investors position themselves to benefit or protect themselves from potential losses. By studying how fear affects behavior on a global scale, we begin to see that it is not just an obstacle to financial stability, it is also a fuel that powers economic activity in ways few people recognize. Fear drives consumer spending. Fear is a surprisingly effective motivator for consumer behavior. Consider how people react to crises, news reports, or even everyday uncertainty. When individuals perceive a threat, whether it is rising prices, potential shortages, or an economic slowdown, they often respond by spending. Panic buying, preemptive purchasing, or moving money into perceived safer goods all become reactions to fear. The global economy benefits from these behaviors because consumption represents a fundamental part of economic growth. For example, when news spreads about potential shortages of essential products or spikes in commodity prices, people tend to stock up. This behavior may appear irrational on an individual level, but on a larger scale, it increases demand, stimulates production, and can temporarily boost sales across industries. Fear-induced spending can act as a kind of economic accelerant, generating activity where there might otherwise be hesitation or stagnation. Even subtle fears can influence consumer trends. Concerns about inflation, health, security, or even technological changes can shift spending patterns dramatically. This is why understanding psychological drivers in economics is as important as understanding money itself. Fear isn't merely a personal emotion. It's a mechanism that subtly nudges billions of people into action, maintaining the flow of goods, services, and capital across the world. Market volatility relies on uncertainty. Financial markets thrive on the presence of uncertainty, which is closely linked to fear. When investors are uncertain about future events, be it interest rates, geopolitical tensions, or corporate earnings, they respond emotionally, often amplifying fluctuations in stock prices, commodities, and currencies. Market volatility, in this sense, is not random chaos, it is the direct product of collective fear and speculation. When fear spreads through markets, it creates rapid buying or selling decisions. Small triggers, such as an unexpected report or a sudden policy announcement, can cascade into dramatic swings because investors act preemptively to avoid losses. This creates opportunities for those who understand and anticipate human behavior, but it also highlights the inherent fragility of systems driven by emotional perception. Ironically, markets rely on this nervous energy to remain dynamic. Without fear and uncertainty, price movements might be smaller, but the momentum that drives innovation, risk-taking, and financial opportunity would also be greatly reduced. This dynamic demonstrates that fear is not just a side effect of markets. It is embedded in the structure of modern finance. Even sophisticated algorithms designed to respond to data objectively often trigger reactions that amplify uncertainty. In this way, fear is both a human and systemic factor that sustains volatility, ensuring that capital flows continue in ways that stimulate the broader economy. Investment decisions are emotion-driven. Investing is often taught as a rational, strategic activity, yet decades of behavioral economics research reveal that emotion dominates decision-making far more than most people realize. Fear of loss, fear of missing out, or fear of being wrong can influence investments as strongly as logic or analysis. Investors often react to perceived risks, even when underlying fundamentals remain solid, shaping capital allocation across industries and countries. See, fear-driven investment decisions create patterns that ripple through financial systems. For example, during times of economic uncertainty, investors may move funds into safer assets like bonds or gold, creating temporary spikes in demand for specific markets. Conversely, optimism combined with subtle fear of missing opportunities can drive speculation in emerging sectors, causing rapid valuation changes. Understanding the emotional component of investing reveals why markets sometimes behave unpredictably. Fear can lead to overreactions, underreactions, and sudden corrections that appear irrational. Yet this very mechanism fuels liquidity, trading activity, and the redistribution of capital. Fear drives the constant assessment of risk versus reward, which is a foundational engine of the global economy. Fear triggers risk aversion. Fear doesn't just create movement, it also shapes caution. When individuals or institutions perceive potential danger, they often become risk-averse, which in turn influences lending, borrowing, hiring, and innovation. Risk aversion slows certain activities while encouraging others, creating a delicate balance that keeps economies operating dynamically. For instance, during periods of heightened uncertainty, companies may postpone expansion projects, investors may hold back on speculative ventures, and banks may tighten lending standards. And while this may appear negative on the surface, these behaviors stabilize systems that might otherwise overextend. Over time, this balance between fear-driven caution and opportunity-driven action produces a self-regulating environment. Economies rely on this tension to adapt to change, redistribute resources, and maintain resilience. In a sense, fear acts as both a brake and a compass, guiding financial decisions in ways that protect long-term stability while still allowing growth. Economic policies react to public anxiety. Fear doesn't only influence consumers, markets, and investors, it also shapes government and central bank actions. Policymakers often respond to public sentiment, adjusting interest rates, stimulus programs, or regulations based on the perceived level of economic anxiety. When fear spreads, governments act to restore confidence, stabilizing systems that might otherwise experience collapse or stagnation. For example, during recessions or crises, why governments frequently implement stimulus measures or liquidity injections to calm markets and reassure citizens. These interventions are often directly aimed at addressing the emotional component of economic activity, reducing panic, encouraging spending, and restoring confidence. Even regulatory frameworks are designed to prevent excessive fear from triggering systemic collapse, reflecting how deeply anxiety is integrated into the design of modern economies. See, this cycle demonstrates a remarkable feedback loop. Fear drives behaviors that influence markets, investments, and spending, which in turn prompt policy responses, which then affect perception and action. Understanding this loop provides a deeper insight into why economies behave the way they do, and why emotions are inseparable from the mechanics of global financial systems. Panic influences stock market swings. Panic is one of the most visible manifestations of fear in financial markets. War and its effects are immediate and dramatic. When a sudden event, like an unexpected geopolitical development, disappointing earnings report, or a major corporate announcement, hits the news, investors often react impulsively. These reactions, when multiplied across millions of participants, create sudden and sharp fluctuations in stock prices. Markets are highly sensitive to perception, so even if the underlying fundamentals remain strong, fear can override logic, creating price movements that seem disproportionate. the consequences of panic extend far beyond the short term. Once investors start selling in response to fear, it often triggers additional selling by others who observe the trend, creating a chain reaction that magnifies the initial impact. This contagion effect can cause indexes to swing by double-digit percentages in a single day. While such volatility is stressful, it also plays a role in redistributing capital efficiently. A panic forces markets to adjust quickly to changing perceptions, creating price corrections that reflect risk and sentiment. In this way, panic ensures that markets remain dynamic, constantly reassessing value and opportunity in real time. Interestingly, panic also creates opportunities for those who understand how fear works. Traders and investors who recognize overreactions caused by panic can capitalize on temporary mispricing or volatility spikes. It is precisely because fear drives these extreme behaviors that sophisticated participants are able to profit while less prepared investors may act impulsively. Panic, while uncomfortable and often destructive in the short term, serves as a critical engine for liquidity, trading activity, and the constant flow of capital that keeps financial systems alive and moving forward. Fear creates demand for safe assets. Fear drives investors to seek security, and this instinct shapes global capital allocation in profound ways. When uncertainty rises, money flows out of risky or speculative investments and into assets considered safer, such as government bonds, gold, or highly rated corporate debt. This behavior is a direct reaction to perceived danger and reflects collective risk perception on a massive scale. The more pervasive the fear, the more pronounced the movement towards safe assets, which can dramatically affect prices, yields, and returns. For instance, a sudden spike in demand for government bonds can lower yields and reduce borrowing costs for governments, illustrating how fear-driven behavior influences both markets and policy. The effects of this shift extend beyond individual portfolios. As investors concentrate funds in safe havens, capital becomes redistributed across sectors and countries, influencing global economic activity. Companies that rely on risk-based investment may experience reduced funding availability, while sectors perceived as stable attract additional resources. Institutions anticipate these behaviors, creating specialized investment products designed to capitalize on periods of heightened fear. Fear-driven demand for safe assets also demonstrates the psychological underpinnings of market dynamics. Investors are not acting in isolation. Collective perception shapes supply, demand, and valuation. Markets adjust continuously to these emotional drivers, and those who understand these mechanisms can leverage periods of anxiety to optimize portfolios, hedge risk, or plan strategic allocations. Business strategies respond to market worries. Fear doesn't just influence individuals, it actively drives corporate strategy. Businesses constantly monitor market sentiment, economic indicators, and consumer confidence to gauge the level of anxiety affecting spending and investment. When fear increases, companies often adjust operations, delay expansion projects, or scale back hiring to mitigate perceived risk. Marketing strategies are also tailored to appeal to urgency or scarcity, creating products, campaigns, or promotions that resonate with consumers' fear-driven motivations. This responsiveness ensures that businesses remain aligned with the emotional currents of the market, allowing them to survive and even thrive during uncertain times. The influence of fear on business strategy extends beyond short-term decisions. Over time, companies learn to anticipate patterns of public anxiety and design operations that can flexibly respond to market fluctuations. Supply chain adjustments, pricing strategies, and inventory management are all informed by consumer sentiment, showing how deeply fear is embedded in corporate planning. Firms that fail to recognize these emotional drivers risk losing market share, while those who integrate them into strategic thinking can gain a competitive edge. Moreover, fear-driven strategy affects the broader economy. When companies adjust production, pricing, or hiring in response to market worries, it changes the flow of goods, services, and labor across entire sectors. This ripple effect influences employment rates, investment allocation, and the pace of innovation. In this sense, Corporate responsiveness to fear is not merely reactive, it actively structures economic activity. Fear, though often viewed negatively, ensures that businesses continuously adapt and that markets remain responsive to shifting consumer and investor psychology. Credit markets tighten during fear. Fear has a direct and measurable impact on credit markets. When lenders perceive a higher probability of default due to uncertainty, they respond by raising interest rates, tightening collateral requirements, and becoming more selective with borrowers. Potential borrowers, sensing the increased cost or difficulty of borrowing, may also become more cautious, reducing the amount of new credit they seek. This dual reaction slows the flow of credit throughout the economy, affecting business investment, consumer spending, and long-term growth. Fear, therefore, serves as both a trigger and a regulator within the credit system, determining the pace and volume of lending. This tightening of credit is not purely restrictive. It has stabilizing effects as well. See, by limiting the availability of capital during periods of heightened fear, the system reduces overextension, curtails risky borrowing, and prevents financial bubbles from forming. Lenders and borrowers are forced to reassess the risk-return balance, creating a natural check on excessive optimism. This cyclical adjustment, driven by fear, ensures that financial systems remain resilient even during periods of volatility. Over time, it establishes a self-regulating mechanism that balances growth with prudence. The effects of fear on credit markets extend beyond individual loans. Tightened lending conditions influence investment decisions across industries, affecting which projects receive funding and which are postponed. Consumers may reduce major purchases like homes or cars, and companies may delay expansions or capital expenditures. Collectively, these behaviors influence macroeconomic outcomes, showing that fear acts as a guiding force, shaping both micro and macro-level financial activity. Fear shapes inflation expectations. Fear also profoundly impacts how people anticipate and respond to inflation. When consumers and businesses expect prices to rise, they adjust behavior in ways that often accelerate inflation itself. Consumers may buy goods preemptively to avoid paying higher prices later, while businesses may raise prices to protect profit margins, anticipating increased costs. This creates a self-reinforcing cycle where fear-driven expectations directly influence economic outcomes, demonstrating how perception alone can produce real financial consequences. Central banks and policymakers monitor these expectations closely because they influence interest rates, monetary policy, and overall economic stability. Rising fear about inflation can prompt preemptive action by authorities to curb spending, stabilize prices, or reassure markets. Meanwhile, businesses adjust strategies to remain profitable while consumers navigate their budgets in response to changing expectations. Fear, therefore, becomes a key variable in shaping decisions that affect the entire economy, not just individual actors. Over time, the impact of fear on inflation expectations demonstrates how deeply psychological forces are woven into economic systems. Fear affects pricing, wages, borrowing, and spending patterns, creating feedback loops that influence both short-term fluctuations and long-term trends. By shaping expectations and behavior, fear serves as an invisible driver of global economic activity, proving that emotions and perceptions are just as powerful as policies and market fundamentals in shaping financial reality. Global trade is sensitive to uncertainty. Global trade is intricately tied to perception, and uncertainty, often fueled by fear, can ripple through supply chains faster than any tangible disruption. When importers, exporters, and logistics providers anticipate potential risks, such as political tension, natural disasters, or sudden regulatory changes, they adjust their strategies accordingly. Orders may be delayed, inventories shifted, or alternative suppliers sought, all in response to perceived threats rather than immediate reality. The global economy, built on intricate networks of production and distribution, reacts to these subtle signals of fear, showing just how sensitive trade is to uncertainty. Uncertainty affects pricing, shipping schedules, and risk premiums. Companies factor in potential disruptions when negotiating contracts, setting lead times, and determining costs, which ultimately influences what consumers pay. Fear-driven adjustments, while sometimes precautionary, also prevent catastrophic failures by creating flexibility and resilience in supply chains. Traders, investors, and multinational corporations are constantly assessing how fear might alter demand or supply patterns, making anticipation of sentiment as important as the goods themselves. Over time, the sensitivity of global trade to fear ensures that the economy remains in constant motion. Even minor fluctuations in perception can create ripple effects across continents, shifting capital, labor, eats, and goods. This dynamic reinforces the idea that fear is not simply a psychological phenomenon. It is a structural force embedded in the mechanisms of global commerce, shaping outcomes and maintaining activity even in periods of uncertainty. Speculation thrives on fear. Fear is the foundation on which much of speculation in financial markets is built. Investors, traders, and hedge funds often react to potential risks rather than certainties, by positioning themselves to profit from perceived vulnerabilities. When fear rises, it amplifies volatility, creating opportunities for those who can anticipate overreactions and underreactions. Speculative activity is therefore closely linked to the emotional state of markets, relying on fear to generate price swings that make trading profitable. This dynamic is particularly evident in emerging markets, commodities, and highly leveraged instruments. Fear drives sudden movements in prices, creating moments of panic or opportunity. Traders who understand these psychological patterns can navigate volatility strategically, while inexperienced participants often suffer losses from impulsive decisions. Fear, in this context, functions as both a challenge and an engine for activity, ensuring liquidity and continuous reevaluation of risk across markets. Speculation fueled by fear also has broader economic implications. Rapid capital flows, price swings, in trading volume affect investment, production, and consumption decisions far beyond financial markets. Fear-driven speculation keeps capital moving and risk continuously reassessed, which sustains market activity and ensures that economic systems do not stagnate, even amid uncertainty. Fear influences employment decisions. Employment patterns are highly sensitive to economic anxiety and fear, both on the part of employers and employees. When businesses anticipate downturns or economic uncertainty, they may delay hiring, reduce temporary staff, or freeze promotions. Employees, on the other hand, may act cautiously, avoiding career changes or investments in personal development due to fear of instability. This creates a feedback loop where fear-driven decisions shape labor markets and economic productivity. During periods of heightened uncertainty, workforce allocation often shifts towards stability rather than innovation. Companies prioritize roles that maintain operational continuity, and employees gravitate towards secure positions rather than pursuing riskier, high-reward opportunities. While this cautious approach may slow innovation, it also ensures that organizations remain resilient and capable of weathering economic shocks. Fear-driven employment decisions illustrate the subtle ways that perception shapes real-world outcomes. Wages, hiring practices, and career mobility are all influenced by collective anxiety, which in turn affects consumption, investment, and economic growth. Fear ensures that labor markets remain adaptive, prompting adjustments that balance caution with opportunity while keeping human capital aligned with evolving economic conditions. Fear keeps capital moving. Ultimately, fear is one of the most important mechanisms that keeps capital in motion. Whether through consumer spending, investment reallocations, our safe haven flows, or speculative trading, fear ensures that money does not remain idle. Investors react to potential threats, businesses adjust strategies in response to perceived risks, and governments intervene to calm public anxiety, all creating a dynamic environment where capital is constantly flowing. Without fear, economic activity might slow, markets could stagnate, and opportunities for growth would diminish. Fear also encourages strategic thinking, so investors analyze risk more carefully, businesses plan for contingencies, and policymakers develop measures to stabilize markets. This proactive behavior, driven by anxiety and caution, enhances resilience across the economy. Fear functions not only as a motivator but also as a regulator, ensuring that both opportunity and risk are continuously evaluated, and that money remains active in productive channels rather than sitting passively. In this sense, fear is not merely an obstacle. It is an engine of economic vitality. By driving reactions, shaping expectations, and prompting strategic allocation, it maintains the flow of capital across markets, industries, and borders. Understanding this reveals a hidden truth about the global economy. Fear is not a weakness to be eliminated, but a fundamental driver that underpins the entire system. If this perspective shifted the way you think about money and markets, remember that staying informed is only part of the battle. Applying these insights strategically is what creates advantage. Subscribe to the channel, like this video, and share it with someone who could benefit from understanding how fear quietly drives global economics. The more you recognize these invisible forces, the better equipped you are to navigate, anticipate, and act in a world where emotion and finance are inseparable.